Hello ladies and gentlemen, and welcome back. In the middle of August, we talked about two things: the midterm elections and seasonality correlating to weakness in markets, and of course the 200 simple moving average. What's since happened from that point is we've seen the Fed not pivoting during the Jackson Hole Symposium, and of course rates going to be staying higher for longer periods of time, pointing really some weakness into this market. But we also know that there are opportunities on both sides, be it both the bull side and potentially the bear side moving forward. In today's video, we discuss both of those levels. But more importantly, we discuss the stats around this 200 simple moving average and what's happened since that point. Can history show us anything about what happens next? Stay tuned, guys. We'll see you soon. Well, welcome back everybody to the show where we talk about stocks, commodities, and cryptos daily. We've got a great show today, and we're going to be talking about the macro data into the key lead indicators, and then of course discuss the charts and the key levels. Let's begin by S&P 500 sector performance year to date. Well, little surprise, inflation and energy are the standouts here. But more importantly, you should be focusing on utilities, consumer staples, and healthcare. When they're performing better, it generally means the market is bearish. When money flows out of those and goes back into some of the more consumer discretionary services tech side of things, we're generally looking for bottoms or recoveries. This is going to be an important thing that we'll bring up on the channel over the next couple of months, so make sure you subscribe because we will be covering money flow in markets, as it will become very important, potentially, of course, in October as well. What about some of the things to do with the 200 simple moving average though? This is a super important rejection that we saw a few weeks ago. And now we're starting to get some interesting readings that can tell us things about how historically this has played out. Trailing 42-day high closes versus trailing 21-day low closes. When we see these reversals occur, it brings up stats in time that are not usually favorable over the next 1, 2, 3 months, or even 1 year of data. It often correlates with some of the worst periods in time for the stock market. And as you see down here, it's less than a coin flip in terms of the negativity that can often come in after this point. It's the same story with MACD reversions or reversals off a 200 simple moving average. Very similar stats, 1, 2, 3 months, very weak, not so good. And when we couple this with a couple of other ideas, such as, of course, inversion yields and what the bond market's telling us, it's basically already saying, hey, we're in a US recession, or at least that's pretty much going to happen. Remember, this indicator's never been wrong technically in history when you've gone over 50%. And effectively, it brings up the point of, will this midterm election year also play the game that it usually does? The middle of August has happened so far. Will we get the weakness through the middle or start of October? And then we have to keep an open mind to the potential of a rally into the end of the year. This is a case that we're looking at right now in these markets. And I think you have to keep an open mind to any of these opportunities should they present, of course, with the triggers using something like technical analysis and some fundamental undertones if you can. Let's look at the correlation throughout history of some of the similar times. These are some of the most correlated markets right now in terms of what's going on. One of the ones we always bring up is 1962. And the reason why we're doing that is because when you think about it, in all of these cases, if there were recessions underway, especially in these markets, we generally saw a double dipping effect. That probably means we haven't hit necessarily the bottom of this market yet in terms of when it's pulling back from this current sell-off after the Fed said, hey, we're not pivoting, interest rates higher for a longer period of time. In all cases here with the highest correlations, we've got back to those lows, if not made new lows, and opened up, of course, much worse situations in these two cases. But we have to keep an open mind to both the bull and the bear cases. That's the nature of trading and investment. Even though whenever everyone else is fearful, there still may be reasons to be greedy. And remember, markets can move in irrational ways. If 2022 has taught you anything, we've seen big rallies followed by big busts several times already. You've got to keep an open mind. So what are we seeing here in the charts? Let's get stuck into some of those. Well, the VIX here firstly jumped off the 20. We've hit that 28 and we've rejected it twice. Is it time for the stock market to potentially show a little bit of recovery? It's been selling off now for quite a few days. Since the middle of August, it's mostly been the sell-off. There was that couple of days of turnaround, followed by, of course, aggressive selling. Well, we'll look at those charts just a little bit later in today's video. Let's look at some other things. Yields. They stay high. Sticky yields, US 10-year 3.112%. It's gone all the way back up and it's created a long leg doji, effectively equilibrium. It seems to like this level right now. The US 2-year, which is more correlated to the stock market at this stage, is at a new high. This is going back to 2007 in terms of the last time we saw a high like this. And this basically is telling us that there could be more pain to come. In fact, the Fed told us, hey, more pain to come for households and businesses in the US. Well, the market is obviously reacting to that. The US dollar, on the other hand, has remained kind of stable since this announcement. It took the high recently and then it's floated down and actually created what you would hope to be a structural base to allow bullish momentum. So if you were looking this on the chart, you would say there's a good chance that the dollar index is setting up for a little bit of bullish move. And the reason why is when you look at the euro, kind of like the counterpart to the US dollar. This is the biggest correlation with that pair. We've seen a pullback to the 61.8, a movement off this base, which is now an incredibly important zone, 99.80 for anyone that's listening in the car. And the market has moved to a 78.6 fib, kind of like the last line of defense. So the current setup is huge supports through 99.20, a big minor support through 99.80, and a market that's not sure whether it wants to go bullish or, of course, go bearish at this stage. It tried to get underneath last night in the previous session. The US dollar actually did the right stuff. The euro did not. It should have made a new low should it have really wanted to go lower. At this point, it's kind of neutral. If it gets underneath this level, it probably pulls back and then sells back off to 99.20. If it gets underneath 99.20, there's a good chance that it goes to something like 97.20 or something like that, so low. This would therefore become what we call a massive distribution. A good way of doing these things is to always look at higher timeframes and to bring it down and to correlate them all together to understand that this is a multi-timeframe thing. If you look at it on this chart, it doesn't really show the signs of turnaround just yet. But of course, things can change in the next 24 hours, and you have to be open to the idea that this is distribution, especially if you get the new low, and then keep an open mind to that 97.20. At this point, it hasn't happened. We'll continue to watch it. Another big worrying sign is, of course, copper, or metals in general. What did we just do? We swept this low. We actually got underneath it, and so far, so good. I can see why people are going bullish potentially on metals at this point. Copper has found a base 1, 2, 3, 4 times, and now a little bit of a fifth time. It's also held this potential area here, which most likely holds orders and stop losses. So it's defended that zone. This is one of those trades where you look at it and you think, well, what are we seeing here, guys? We're seeing a key level. We know that this is super important. If the market breaks underneath this, it's highly likely to find significant weakness down to something like a 3.45. But at this stage, it's kind of recovering as best it can. So let's look at the 15-minute setup so far. What have we got? We've got a market come down, bull, come down, bull, come down. So far, so good in terms of bull. What's a key level? 3.58. Break, pullback, potential long. That's the type of way that people would look at copper. And of course, this can show you the health of the economy. If copper loses this position, it does bode badly for the overall economy and of course shows us that there is destruction in demand. Maybe that's what the Fed wants. Well, it is what the Fed wants. So therefore, it could be a big opening there. But it's something that we're looking at. Key level here for copper for sure. And we sometimes bring that up on these charts. Let's move over to gold. What's going on there? Well, gold is almost at our level. We've talked a long time. We actually up here talked about the weakness we expected in gold. So far, we've had gold on the yo-yo. That doesn't mean you're always going to have it, and you have to keep your ego in check on these things. You might say, okay, yes, we got that level. Yes, we got this level. Yes, we were bullish. Now we're bearish, and we're potentially moving towards the bullish idea around that 1715 to 1710 zone. That's a zone that we've talked about now for weeks and weeks, ever since it came down and started to turn from this very key zone. So gold's getting back down. Why? Because there's a real manipulation going on in gold to do with money flow. I told you guys I'll update you if I continue to see the big guys stacking gold. At this stage, they stack, they stack, they stack, they stack, they stop stacking about here. Will they stack again at these levels? This will give us a good insight to whether gold is really going to boost through the next couple of months to the next year and show us some real strength. There could be a sign that gold does it, but we're going to have to beat inflation before that does occur. UK oil, what's going on? 99.7. Fell off from this zone up here. We got close to that 107, 107.50 and we sold off pretty aggressively. This is a bit unfortunate in terms of if you were long. We did actually take the low. So now oil becomes a little bit, I guess you would say, iffy. 107, 107.50 was certainly a good zone. We've taken these lows. We probably rally here on oil. That's the most likely scenario. Back up to like at least a 102. And then at 102, I think a big decision will be made. Will the bears get back hold of oil and keep pushing it low, really creating much lower points for oil? Or will the bulls take over and snap that 102.50 high, pushing us most likely at that point back to the 107 kind of 50 range, or 107 for Brent in this case. This is a super important zone and of course worthwhile focusing on when it comes to oil. Tesla broke to a new low. Let's get into the stock market now. Not so good. I mean, Tesla literally came underneath. It kind of swung this little low here and then it found some rallies. Very important point now in the stock market over the next 24 hours. We've got support, support, resistance, support. Could it become resistance, sell off to this gap down here at 250? A lot of that's got to do with the SP 500, which we'll be looking at in just a few seconds. What about Apple? Well, Apple just filled the gap we've been talking about. 156 hit, little bit of a bullish buy off that zone. Very important level here for Apple. If it's going to find relief rallies, it probably should do so around here. So an interesting area. And we'll look at that we'll talk about it more when we go to the Nasdaq. What about the DAX? The DAX hit that support, becomes resistance side, sold off a little bit. I still think the DAX is mostly reliant on the SP 500, but that was an interesting move. And if you got it, congrats to you. It was a pretty decent sell-off from that zone, but obviously you would have had to be fast and nimble in these markets right now. US 100. Now this is where things get interesting, the Nasdaq. We have a trend line coming off the base. We have a head and shoulders that has almost completed. And in the bear side of head and shoulders, we generally don't see full completion. Of course, just around above 12,000 is technically the previous resistances and supports. It could spike into this zone, but it's currently finding a little bit of structure around this trend line and key level. So let's break down a few things. First up, we'll put a fib on the entire move so far. And you'll notice it's come back to a 50 fib, 50% of the entire move. Pretty incredible level, obviously a interesting zone. When we scroll down to the 1 hour, what have we currently got? We've currently seen it come down, make a new low, breach those previous peaks, breach this a little bit and find a little bit of resistance, and potentially now looks to find weakness. But will the buyers step back in around this 12,300? We need to look at the S&P 500 to really come up with a conclusion about that. Here we've got some key levels. Now, of course, admittedly, we were looking at this and this level for the shorts. 41.25 to 41.30 and 40.90, 40.80 zone. It got to like 40.70 and sold off pretty heavily. A few of you were in this. I know people in our private community and public community were trying to sell it off. Fair enough. Well done. If you're nimble and fast, all good. If you had a strategy around that. But what happens next? So the first thing we want to do is, of course, draw up something like a Fibonacci. If we look at Fibonacci from the move to the bottom and we think about it, we're at that previous support. Resistance becomes support, a key zone for sure. This is an important area. We like the 39.20. There's a gap close here. There's a weekly close here. All sorts of things going on at 39.20. But could it stop before that? Well, there is a case where it could, but it will need to structure up first. So let's have a look at the 10, 15 minute chart and have a look here at how the market has currently been trading. Notice during the time of this recording, we've hit this high similar to the other one, obviously close to that support, and we're just hitting the high again and we've made a new low. So if we take this high, I would like to see it kind of structure like this, take the high, come back, and then go long. And if we see something where it takes the high, that's going to be incredibly important to a potential activation here on a long. For now, the trend is still technically down, and we're looking at that 39.20 as a major key support. We have to be open to this idea here of 39.60 holding also some orders. 50% fib, certain trend lines on the Nasdaq, certain things that are going on other markets as well in terms of synergies. So it's a very important zone in this next kind of 40 points for the market. The 60 here down to the 20, all of this is very open. And at this stage, we're still finding sell-off pressure. But will we structure up through this futures market and then, of course, look towards those longs? Keep an open mind here over the next 24 hours. Very important levels coming up. I'm open to both this being a potential buy for a little bit of a move and, of course, the 39.20 being a potential buy. Where does it go from that point? Let's say it does go and then go long. Well, of course, 40.60 is going to be a little bit of resistance now. But it also could quite easily go towards 40.90 and 41.25. It's one of those cases where we look at scaling off part of your orders into these levels. If the market does breach through this, I still think it will pull back later. But this now opens up a very serious question to whether we then would rally through that point. And we'll bring that up in another day, should it happen and should it occur. For now, major sups, 39.20, and potentially a structuring in here, should it occur. And you have to keep an open mind to these things. Remember, let the market show you that it's ready to go. Patience, react, don't try to predict too much. We're reacting to the price action structure and finding key levels that we want to react to. The S&P 500 in general has shown this on the real market. This is the S&P 500. You can see the gaps it's left behind. You can see the current big 39.20 zone. And of course, there's a big gap in there as well. So there's a lot of stuff really correlating to that zone. What do the options tell us though? Well, the options expiration here for the 31st is still at 408. Current market, well underneath that. Where are the big strikes? Well, these poor suckers, they've lost their positions. 445, 440 calls, gone. Gonski. Unfortunately, if you're one of those, you've lost your position. Very, very high chance at the time. 400s, certainly a very key point here for the markets. But what I think is most interesting is the Friday options expiration. We have 400s with a fairly significant amount of puts. So come Friday, it does make some sense that the market would rally back up to try to get above 400 before that point. This is kind of what we would call a put wall this week. Now, it's not super important. It's not the third week options expiration, but it's still important to know that 65,000 puts expire at 400 with a maximum pain of all options expirations being at 413. So pretty key zone here on these markets right now. Ethereum is also showing us some signs of bullishness, obviously forming a base with lower lows, rallying, pulling back, and then allowing people into a pretty nice kind of little bullish move here. Bitcoin is similar. We tested those lows of 19,500, and at this stage, we're rallying up. Is this a precursor for the stock markets? Well, it's certainly showing us some bullish bias. And at this stage, what it could also become is a double bottom pattern. Now, if we think about double bottom patterns, we take the distance from here to here, we try to proof that. It proofs incredibly well to a key resistance level that we're moving forward with Bitcoin. So again, all kind of proofs towards this potential rally here coming. Could we see a little bit more downside? Of course, the stock market could push that 39.20 narrative, but it also could be setting up here for a decent structure, and you have to be open to both opportunities. If you haven't already, come and follow us at Twitter, at FX Evolution. You can join us and follow along there. We're posting a whole bunch of things. And of course, the calendar moving forward, guys. Non-farm employment change coming out here, 8:15 a.m. New York time. Then we scroll down. We've got ISM manufacturing PMI on Thursday, 10 a.m. And then we have Friday, September the 2nd, the big number. And probably what's holding the market back a little bit, the non-farm employment change. This is the big one. The jobs numbers for the US, 8:30 a.m. New York time, 1 hour before the market opens. If you haven't already, joined us in the Discord community, the public, or of course, join our free 7-day trial in the private community. We share a whole bunch of charts and we've got some exciting new offers coming out soon as well. And if you enjoy the content, please subscribe, smash that like button. We'll see you in the next one. Bye for now, guys.